Inspiring interviews with today's top landlords. This is the Rental Income Podcast. And now, Dan Lane.
John, when someone wants to invest in a rental property, finding a good area to invest in is really important. What do you think some things are that people should be looking for when they're trying to choose an area to invest in?
Look for areas that are bringing in the jobs. I think that's one of the key factors for Huntsville, Alabama here for the last few years that have really attracted a lot of out-of-state investors, but also a lot of people just moving here. I mean, they're moving here for the jobs, they're moving here for a better quality of living. Taxes are low, so that's another thing I would look at is which regions of the country have higher or lower taxes. Of course, schools are always a great factor, and so we've really focused on building either brand new schools or expanding our schools, education, growing or not growing. Certainly, if a city is growing leaps and bounds, and that means there's going to be a lot of people relocating there that may not be interested in buying, but would want to rent.
The problem is when you find an area that has good jobs, good schools, and is growing, and you combine that with historically low interest rates and a housing shortage, it means prices are going to start going up, and it makes it very difficult to find really good deals on a rental property. A benchmark that a lot of investors use is called the 1% rule. If you're not familiar with that, it basically means that if you buy a property, you want it to rent for 1% of the purchase price. So if you were to buy a property for $100,000, you want it to rent for $1,000 a month. And if you follow that rule and you buy a property in a good neighborhood, the property's in good condition, you have a pretty good chance that you're going to actually be able to make a profit on it. The problem today is that the 1% rule is getting really difficult to find in a lot of areas. So how can you invest if you're not able to meet the 1% rule? Well, John has some thoughts about that. We're going to talk to him about that and find out if the 1% rule is dead. We're also going to talk about what John looks for in an investment property, and we'll talk about his portfolio. Joining us on the show today from Huntsville is John Brooks. We'll take a really quick break to thank our sponsors. We'll come right back and we'll talk to John. A good deal on a rental property isn't going to last very long. To win properties today, you need to move quickly when a deal comes on the market, but it takes time to analyze a property. I want to let you know about an app where you can analyze deals on your phone in seconds. It's called Ask Rick, that's RIC for Rental Income Calculator. You can analyze a deal with the push of a button. You can figure out the rent, your mortgage payment, your expenses, and figure out the cash flow. If the numbers make sense, you can make an offer right there on the app, or you can send a calendar invite to your agent to see the property in person. Ask Rick is currently offering a free 7-day trial. Just search for Ask Rick in the App Store or go to Just Ask Rick. That's RIC, justaskrick.com. It's a lot of work to find a really good rental property, and when you actually find that property, you want to make sure you're working with a lender that can get that loan closed. The lender that I recommend is Chaley Ridge from Ridge Lending Group. She's a nationwide lender, and her specialty is helping investors finance rental properties. She has a ton of loan programs, and she can find something customized to you for your situation. If you want to find out more or you're ready to get started today, just go to ridgelendinggroup.com. That's RIDGE lendinggroup.com, NMLS 42056. John, I was talking to a new investor the other day, and he was telling me it's just too difficult to find rental properties right now. So what do you think? Is this just too tough of a time to get started?
And you just got to take that leap of faith. You just got to, go out there and do it and get one. And so it's not going to look as attractive on paper as it did a year ago or 2 years ago. And for all those that are listening to seminars or reading books, and they're still kind of preaching that 10% or 12% or return on investment, the 1% rule. I mean, I think that's outdated material, and it's not really fair or true to the market we're in. And so, again, markets come and go. They change. Prices go up and down, things like that. But you have to look at the big picture when you're generating wealth. And it's not just hey, this year or next year, but, 3-year plan, what's the 5-year, what's the 10-year, and especially if you're buying multiple properties, some are going to look have a better look at like 3%, maybe some have 5%, some have 7%, and so really in the market that we're in, really have to just look at the big picture and say, what does that all average out to be? Certainly more than you can make in other type of investments, and it's a property. It's tangible. So whatever the market does, up or down, values increase, decrease. At the end of the day, you still have a property that the mortgage is being applied towards each month, and you may have to hold it longer, or maybe be able to sell it quicker and make more money. So just want to encourage people to just look at the overall big picture and don't buy something based upon you have to have that $100 a month.
That's a really good point, because when the 1% rule was a lot more common a few years ago, interest rates were a lot higher. And if you're paying 5 or 6% interest and getting the 1% rule, versus today getting a much lower mortgage payment, but not getting the 1% rule, you might kind of come out cash flow wise or profit wise at the same place at the end of the day.
Yeah, and that really is the deal. That's the discount, is the interest rates. Really, that's really the bottom line. I know everyone wants to get a property discounted, off market, negotiate, but really the negotiation, the discount is the interest rate being so low right now compared to, especially when I started in the real estate industry, 2003 and other years where they're 5, 6, 7%. And so until interest rates really continue to increase, you almost can't afford not to borrow money at these interest rates and prices.
Now, Alabama is known as a good cash flow state. Does the 1% rule basically not exist anymore?
It doesn't. I haven't seen 1% in, I don't know, maybe a couple of years now. And so, again, the C class is going to look a little higher on paper and it's more attractive, but in the general overall picture, it really doesn't. And I mean, there may be some really, really rural areas far away from the major cities that may have a little bit higher, but usually I've learned in those areas you don't have a strong job market, so therefore the rents aren't that high. So most likely, probably in those areas, that's gone away. But I've had the opportunity to talk to many, many investors since I usually ask them that same question. Hey, are you finding those type of return on investments? Are you seeing that in your city, the other cities? And of course, that's the reason why they're searching out of state, because the answer is no, that they haven't been able to find that. And so everybody wants that, but really, I think that's kind of gone with the market that we're in.
So really, you're buying rentals or investors that are investing in your area. Are they buying really for appreciation and for future cash flow? That maybe your rent is $1,000 a month now, but maybe in a couple of years it'll be $1,200 a month. Yeah,
they are. I mean, certainly that's not the only key element for investing right now. I mean, appreciation is a great thing. One thing that really no one ever really homes in on is that, hey, each month you're making payments towards your principal, and it'd be behoove an investor to actually throw more money towards their mortgage payment, just like you are supposed to do on your own primary residence. I mean, just think about if every investor just did extra $500 or $1,000 per year throw towards their investment properties. I mean, certainly in that 5, 10, 15, 20-year period, I mean, think about how much interest they could knock off their principal. So I think there's just a lot of more elements to the big picture that sometimes when I talk to investors, they're solely keyed in on the numbers. The numbers have to work, and I totally agree. They need to work. They should. But again, as prices keep increasing, when you start looking at the big picture, then it makes it easier to pull the trigger or even buy more, even if you have a pretty large portfolio, just to continue to buy, because there's so many other really advantages to buying real estate.
So what's your strategy with your rental properties? Like, do you want to get them paid off, or are you looking for the properties to appreciate and then make money that way?
Some of my properties are completely paid off because I believe in the cash system. So I know a lot of investors get mortgages. A lot of them I've been working with are pretty heavy in cash right now. But, I like things paid off. I mean, I just think, again, it's an easy way to continue to build wealth. I don't like the strategy of continuing to borrow, get yourself in a lot of debt to make investments. I think that's what got a lot of investors in trouble. And when the market crashed, is they kind of overextended themselves, if you know what I mean.
Mm-hmm.
So I think having a large reserve on each property, I mean, there's always been that rule of thumb on any property, you should have 6 months reserve. I mean, that's one of those Fannie Mae, Freddie Mac guidelines that they've had for many years in the past. And I think that's just a good rule of thumb to live by, because there are factors that can come up with your own personal life, your job, or whatnot. And so I think having a reserve is certainly a good thing per property. But yeah, I mean, I like paying mine off. I mean, some of the larger multi-million-dollar projects that we're involved in, certainly those have mortgages, and we're not throwing extra money towards principal because there's a lot of partners involved in those syndications and things along that nature. But as far as my own personal real estate, then yeah, I truly believe in that. And I work with a lot of investors that have that same mentalities, because when you really start looking at the numbers on a property that's completely paid off, they get very attractive very fast.
Right.
On that cash flow, especially when you've owned a property for a couple of years with no mortgage.
Did you buy those properties with cash, or did you take out a mortgage and then work on getting that mortgage paid off?
There's a little bit of both. I mean, certainly, and again, I sell a lot of real estate, so that's helped me have a lot of liquidity to throw at any kind of investments. And I've been doing this for many, many years now. So I think that alone has helped, I guess, have a high net worth. But yeah, I mean, it's just a mixture. I mean, some of them just pay cash straight out, which really, I mean, cash is king has always been that saying. It's not certainly the only guarantee that you're going to secure a property, but having either a business line of credit or some kind of equity line of credit, buying the property cash certainly helps any investor right now, as competitive as it is in this market, at least be in the top 3 or 4 on the offers. And so I have a lot of clients that buy cash, secure the property, and they refinance it, kind of pull some cash out of the strategy there. So cash certainly is a very good way to buy property, regardless if you end up putting a mortgage on it or not in the end.
Yeah, I really like your strategy. So, I mean, you're taking your active income, which in your case, you're a realtor, but for someone else that has a job doing whatever you do, you're taking that active income that you work for every day, and then you're putting that into real estate that's generating you passive income. So eventually, as you build that passive income up and up and up and over years, you eventually will have enough passive income to live on one day if that's what you want to do.
Yes,
right?
sir. I think that's certainly a good plan. And you know, in my industry, we don't have 401ks and IRAs and things like that. And so if you're in an industry and you're fortunate and blessed enough to where your companies match that, I think that's a good retirement plan. But again, as we go back to the ugly days of when the market crashed, saw a lot of people's IRAs and stocks and all that plummet. So that's why I like tangible real estate, tangible assets, to where that you can see and touch and feel, regardless of what happens. You're in control of that property in a lot of aspects. We're not in control of what the market is willing to bear, but we're in control of how we handle that property and what we do with it. And hey, if you need to keep it an extra 2 or 5 years because the market went up or down, then so be it. But without an IRA or any kind of investment for my company, investing back into me, I think that's a good strategy for people like myself, is to invest in real estate.
I want to ask you about classes of properties and which investment you think is the best. Before we get into it, can you just define for anyone that isn't familiar with the term what A-class, B-class, and C-class properties are?
Yeah, no problem. So, I mean, certainly, I'm sure everyone has their own criteria per se when they're looking at A, B, and C. But as a general rule of Usually A-class properties are very nice neighborhoods. A lot of times they have HOAs. One good thing is our HOAs here in Huntsville are not very expensive, like literally like $350 annually, which includes a swimming pool. So pennies on the dollar for that kind of thing. But usually they're top schools, white collar tenants. B class, I'd say you're in the same ballpark there in the criteria. A lot of times you don't have HOAs per se. Some of the homes, or at least here in Huntsville, are a little bit older. Maybe they're got some age to them of 20, 30-year-old, 40-year-old properties. A lot of times they're a little bit more rural out in the county areas, which is fine. And then, C class is a lot of times it's not the best schools. It's usually the least expensive real estate. It's a lot of times in some cities, it's heart of the city, older areas of the city. Certainly that's the case here. It's a lot of in the heart of the city, even though we've been doing a lot of reurbanization and revamping some of the C-class areas. I mean, A-class isn't going to be as sexy as some say on paper as far as your cash on cash and return on investments. B is going to be a little better. C is always going to look better on paper, but in my experience, if you don't have the stomach for C type of tenants, then especially if you're out of state, you may want to pass on that, especially if it's your first investment property. Or if you just want to diversify and you said, hey, I'm fine taking a lower rate of return on an A class, I'll get a B, or hey, I'll get a couple C's and diversify. I think that's probably fine, because by that time, most time investors are a whole lot more experienced. But usually the C class, in my expertise, is the ones that a lot of times you have some evictions, you have tenants that are living check to check, they're having a hard time making the payment, or a lot of times they just have a lot of distress in their life situations, things like that. So again, it looks better on paper on annually, but if that type of tenant does some damage to the house or doesn't make some payments, or you have to evict them, then usually that higher percentage, 8-9+% return on investment usually shrinks down pretty quickly. And so
now, what about in your personal portfolio for single families that you own as rentals? What are you buying? Like, do you like the A class, B class, or C class personally?
Well, I like A and B class. Certainly, we have some multifamily in C class in our large portfolio. And by the way, our portfolio multifamily, I believe we're up to about 90 doors right now on there. So most everything's A and really B plus. The C is what continues to give us the hardest time and have the most turnover. We're always fixing stuff, renovating them, things on that nature. So I prefer A and B, but again, I've been doing this a long time. I probably have a little bit more net worth, more liquidity than your brand new investor, or maybe someone that's just starting out and has one or two properties. So we all have to crawl before we walk, and then before we run. And so certainly C class was a good springboard for me and other investors and their portfolios. And I've gone back many years where we sold C class or we bought C class, then turned around and I helped that investor sell it a couple of years later. And then, they did very well for it. And so generally speaking, it seems like a lot of people that buy C class, they retain a little bit less, maybe 3 years or 5 years, 7 years, something like that, and then turn around and sell it. I mean, of course, you see that again also in A and B. Usually if you see someone selling A and B, it's just because the property values, in my opinion, have gone skyrocketed, and they say, hey, I can make $80,000 or $150,000 on this house, or my life's changed and I want to buy bigger and better real estate or whatnot. So everyone, of course, sells their properties differently, but it seems like the C class, I don't want to say they learned their lesson, but it's kind of like, hey, I owned it for a couple of years. On paper, we did okay. It wasn't bad, but, usually they want to grow their portfolio, buy something better, things like that.
My biggest takeaways from talking to John today is that this is still a great time to buy rental properties and to own rental properties. There were a couple of things he said that really stood out to me that I just wanted to point out as we wrap things up. The first one is I liked when he said that your discount today isn't necessarily going to come from the price of the property. It's going to come from the interest rate. And I think that is really true, that these interest rates that we have right now are so low, and being able to lock in a fixed 30-rate mortgage for 3.5%, 4%, whatever the rates are today, is a really big benefit that I know we'll be kicking ourselves at some point in the future that we didn't lock in more low rates. The other thing is that I think he was right when he said that a lot of investors don't really give a lot of credit to mortgage paydown. And that is a really good benefit, that every month when you make that mortgage payment, some of that money is going towards paying down your mortgage. So I think you need to give that some credit when you're evaluating deals. And then the other thing to keep in mind is that rents are going up and prices are going up right now. And sure, we don't know how long this is going to last for, but I know personally I've been able to push through some pretty good rent increases over the last year, and your deal might not meet the 1% rule today, but it may at some point in the future. So I wouldn't be so strict when you're evaluating a deal that it's got to meet the 1% rule or you're not going to buy it. I think you can have a little bit of flexibility today. If anybody is looking to invest in Huntsville, or if you want to connect with John, I've got his contact information on the website. You can find it at rentalincomepodcast.com/episode 339. If you find a really good deal on a rental property, but maybe something in the past has stopped you from getting approved for a mortgage, don't let that be an excuse to pass on that great deal.